So now that I talked to you about all the different investment instruments that you can allocate towards your RSP, and I went into detail about the mortgage investment, I want to tell you a little bit more of what you should do in order to know whether your registered account is doing well. And this is where the management of your own account is very important. One thing that I want to stress is that it's very important to diversify your portfolio within this collection of securities or investment instruments for you to then on average receive a return on your investment that, depending on your stage within your retirement plan or your long-term plan, but on average you want to be receiving about 5 or 6% return on your investment. Now, this is extremely important because remember that I mentioned that it's ideal for your retirement plan to grow over the period of time that you have it invested within that particular plan, right? So what I notice a lot within my experience in the banking industry is that a lot of times they're performing a lot lower than 2%. Why? Because a lot of people have them in the lower return investments, very conservative returns that are potentially GICs, or some of them are just have them a savings account, and because of that is earning a lot less than 2%. And there are two very important things to know of why that is potentially harmful to your investment. The first one is because inflation in Canada is approximately 2%, which basically means that if you're earning less than the inflation rate, you're essentially losing value every year of your money. So you at least want to earn higher than inflation rate, because otherwise the investment that you did today, 30 years from now, is not going to be able to purchase the same things that you did today. So that is basically the simplest way of saying, make sure you're earning higher than inflation, otherwise your money won't sustain the same purchasing power. Second reason why it's very harmful to have it a below 2% return on your investment is because a lot of times your retirement goal, depending on your stage in your life, you have potentially 10 years, 20 years, 30 years, 40 years to save. The amount of growth within the RSP, if you have it below 2%, it means that it's not growing substantially every year. So it requires you to do three things: either save more because you're not growing your money fast enough, or retire much later, so work more, right? Or die sooner. Nobody wants that. But those are three things that you can do if you're not earning sufficient amount of money in your RSP, or your tax-free savings, or your RESP, or your LIRA. So these investment instruments, you can categorize them in two different classes: fixed income investments and equity investments. Fixed income investments, it basically means you have, like the name says it, you have a fixed income. You know what interest rate you're receiving, you know the term, and as such is categorized within the fixed income. Fixed income investments tend to be more conservative, they tend to be less volatile, so they change in value less frequent. Equity investments, they are invested into equity, as the name says it, so that would be stocks, some mutual funds, because mutual funds, some of them are purely invested within stocks or equity related investments. So it's very important for you to have a combination that overall will give you a high return on your investment. I noticed that a lot of people had either too much on the fixed income side or too much on the equity investments side. So why? Because they had either all of it in GICs, and like I said, most of the times they're performing well below inflation rates, and as such they're not growing as they should, or they have too much on the equity securities and it's very volatile, potentially losing money because they don't know what they have it invested on, and overall the portfolio is not performing well. So it's important to have a mixture of the two, because that way you have a well-balanced portfolio that is going to be earning on average about 4 to 6% return on your investment, that will be potentially less volatile and ensure that year by year you're earning the desired return on your investment. Now, in terms of diversifying your portfolio or creating an asset mix in between the different investments instruments that we talked about, one thing that I would like to talk about, and in my experience, it's helped a lot to use as reference, especially for people to understand how to well diversify your portfolio. Take CPP, Canada Pension Plan, as an example. Canada Pension Plan is one of the best investments in the world. It's actually one of the best ones and one of the largest ones in the world. In Canada, it's the top one, obviously. And as you know, this is the fund that handles your retirement fund through CPP. So if this is part of the income that you will be receiving in your retirement, it only makes sense that you try to mimic some of what CPP investment fund does, tailoring to your own needs. So to give you an example, I want to show you a pie graph that shows the current asset mix that CPP uses. So as you can see, it has invested approximately 28% in public equities, 24% in private equities, 12% in credit. Real estate, it's invested 11%. 8.6% in infrastructure, and in bonds, it's invested about 11%. Now, if you see, it's taken all the different investment instruments that we talked about and it's allocated them according to how they think they can perform the best. For you to have an idea, over the past 5 years, CPP has performed on a yearly basis, on an annualized return on your investment, take a guess. It's actually much higher than 4 or 6%. They have performed close to 10% over the past 5 years on an annualized basis. And on a 10-year annualized basis, about 10.5%. So you see how successful they have done that. Now, they need to do this because the amount of money that they receive through your CPP contributions as an employee right now, it is not sufficient to fund the pension of those people that have already retired. So they have to grow the investment just like you have to grow your own registered account in order to meet your retirement goal. You can't just rely on the contributions and just not doing anything to those contributions. Now, if you see this pie graph, this gives you an idea of the specific investment instruments that they have invested. But if you dissect it into the two asset classes that I mentioned to you, or the two type of securities that I told you, fixed income and equity investments, they have a 51% equities, 49% fixed income investments. So if they have done this, and this is potentially 40% or 50% of your projected income at retirement, you should try to aim to do a similar thing. Just to give you an example of a well-diversified, well-balanced, well-managed portfolio against a not well-balanced or managed portfolio and how much of an impact it makes, I'll talk about an example. If you're planning on retiring at 65, and let's say that you want to have an annual retirement income of $30,000, in that case, in order for you to potentially retire at 65 and have sufficient funds into your 85 or 90, you will need to have $770,000 if your investment is earning approximately 2%. Now, this is the example that I'm going to give you as if you are not actively managing your portfolio and it's not well balanced, well invested, well diversified. If you're starting to save from age 30 or 40 and you're earning 2% on your investment, with this specific example, you would have $350,000 at age 65. But because you need $770,000, you actually have a shortage of $422,000. Yes, you were saving for your retirement. However, your investments were not growing at a sufficient pace for you to really meet your goal, which in this case was $770,000. And also past your retirement, so once you are already retired, if you continue to earn 2% on your investment, and because you're liquidating some of those investments, you're also not earning as much as you can in order to fund some of those cash flows. Now, if we were to move on to the next example, if we keep everything the same, if you're still wanting to retire at 65 and you still want to receive $30,000 of net income, however, you're investing them smartly, they're well balanced, well managed, well diversified, and is generating a 6% annual return on your investment. In this case, as you can see, you will need approximately $500,000. And you may say, Victor, why? Why in the previous one I needed $770,000 and now you're telling me I need a lot less? Why? Because in this situation is assuming that you will continue to invest smartly even at retirement. So those funds, those $500,000 will continue to earn a good return on your investment at 6% and fund some of those cash flows through your retirement. We're talking about that you're generating almost what you need, about $25,000, almost what you need every year for your retirement. But most importantly, I want you to see what you will have at year 65. It's approximately $780,000. So you actually have a surplus of $282,000. Why? Because even though these two examples is assuming that you're saving the same amount of money, but one is earning 2% and the other one is earning 6%, and you can see the value of the growth of your money. Why? Because it grew much faster, and as such, it actually generated a lot more than what you actually needed for your retirement. In this case, it grew to a total balance of $780,000, so having a very comfortable surplus. So technically, you don't have to stick to your $30,000 annual income. And actually, in my opinion, a lot of people aim to have a lower disposable income than currently. For me, I want the opposite. I want to live large at retirement. Why did I work all this time in order for me to have the same or lower? No, I want to have a better standard of living. So in recap, remember that the first scenario that I showed you, it was assuming that you're saving the same amount of money, but saving it at 2% annual return. And as such, you had a shortage and you had to either work more or save more. The second example, well balanced, well invested, well diversified, same amount of contributions, but in this case, earning a higher return on your investment, such as 6%, and in that case, you actually have a surplus. So the same amount of money being saved is just invested smartly into investments such as the mortgage investment or more balanced investments that are giving you a higher return on your investment, is bridging the gap and actually surpassing it of what you need at retirement.